Welcome to Barenaked Money, the podcast where we strip down the complex world of finance to its bare essentials, with your hosts Josh Sheluk and Colin White, portfolio managers with Verecan Capital Management, Inc.
Welcome to the next edition of Barenaked Money, and this will be one of the episodes that gets played forever into the future, Josh, because we're going to predict 2025. So we are going to be held accountable for what we talk about in the next 30 to 60 minutes. So I hope you're ready for the pressure. Are you ready to live up to the future's expectations of us?
Well, that's where you're wrong, Colin, because with these predictions, podcasts, articles, whatever, the beauty of it is the commentators can never be held accountable for their predictions. This is how the world works. There has never been somebody that's been held accountable for their predictions. So that's why we do these. We are totally off scot-free, even if they're totally outlandish and come to be 0% true at the end of the year.
You have a different friend group than I have. So we'll leave it at that. My personal group is going to look for everything I've ever said that was wrong and hold me accountable forever. It's kind of how they show their love. So maybe that's just a very specific to me. So maybe you're right. Maybe we're fine. We can say whatever we want.
Well, I do say that a bit tongue in cheek, and all of these predictions that we do are a bit tongue in cheek, quite frankly, because we realize the limitations and the silliness, quite frankly, of doing predictions like this. So ours are always a bit off the wall and can only be taken like 80% seriously, most of them, some of them less.
But the upside is pretty big. If you're like Dr. Michael Burry and you get one thing really, really right, like for the rest of your life, people are going to call you up and ask your opinion like forever based on being right one time. So
yes,
there's an asymmetric risk here. Like this could set us up for life, Josh, if we say the right thing.
Yeah, there's a very high reward for making an outlandish claim and being accurate with it, or I should say being right, maybe not accurate, but being right. And there's very little downside to throwing out 10 predictions that totally turn out to be completely wrong, because we can always come back and say, well, we knew that probably wasn't going to happen.
I can't wait to see where we go with this. As always, Josh has got his list. I have a list in my head, and we haven't compared lists. So I'm going to let Josh go first with the fear that everything I'm thinking Josh has already thought about. But I'm confident I'll be able to find another angle on something that Josh is about to introduce to us.
Yep. So as usual, we don't follow the normal convention. So I have 7 predictions that I've come up with, which is a totally random number based on something that I thought was interesting. But I have to apologize. I do have 2 that are loosely or directly related to politics. So I will ask you, do you want me to lead with the politics ones, or do you want me to end with the politics ones?
Let's flush the toilet early so that we get it out of the way. And
okay.
Before you begin to speak, I'm very disappointed in you. Now we'll see if that changes based on the content of what you talk about. But the fact that we're talking about politics is disappointing me, Josh.
Yes, no, I'm disappointed in myself, Colin, if it matters.
It does.
Yeah, okay, good. So first prediction here. Trump will not find $2 trillion in savings through his Department of Government Efficiency. So if our listeners recall, one of Trump's campaign promises was that he was going to make the government a lot more efficient than it is today. And he's brought in the brilliant, the genius, the politically savvy Elon Musk to deliver on this mandate. And the 2 of them are off to the races already. So their claim is that they're going to find $2 trillion in savings for the government. Let me tell you why I think that's not going to be the case. And I'll just give you a little bit of a tidbit from our friends at BCA Research who brought this information to life for me. So I'm going to talk about the Department of Education. The Department of Education in the U.S. spends about $200 billion per year. Now, a lot of this efficiency, so-called efficiency that we're going to find, or the U.S. is going to find, is by culling the masses of public employees that are not very efficient at their jobs, I guess. Of the $200 billion that the Department of Energy spends, do you know what percentage or what amount of that $200 billion is actually spent on employee salaries?
No idea. That should not surprise you. I don't know that.
No, I'm not surprised. Take a guess. Take a random guess, and a totally uneducated guess.
1 billion of it.
Oh, okay. So you obviously know a whole lot more than you think, because that's exactly the right number.
I'm a genius.
You are a genius. So the Department of Education has 4,000 employees and they have about $1 billion in salaries. So that means that 99.5% of what they spend is not on employments or salaries or these inefficient public employees. It's on other things like entitlements, like student aid and things of that sort. And actually, if you look at the broader US budget picture, about 80% of what they spend is on what is considered non-discretionary or defense spending. 80%. And I think their total spending is about $6 trillion. So if you're telling us that you're going to find $2 trillion of savings, you basically need to cut that entire 20% of discretionary spending to zero overnight. Good luck.
See, Josh, time for school, because I'm going to go on the other side of this and guarantee that he is going to be able to declare victory. I will guarantee that he will be able to save $2 trillion, because you are making the same assumption that many people make when they hear something like this, and you ignore accounting. When governments talk, they didn't say, I'm going to save you $2 trillion this year. They said, I'm going to save you $2 trillion. So they're going to institute programs now that don't come into effect until after they're no longer in power, that cause savings to happen, including cuts in defense spending, and then do a present value calculation of that and announce victory. It's how accounting works. And, the problem with looking at what he's saying and trying to interpret it as you would think you should interpret it, he'll be able to declare a victory. It's not going to be that tough. He can announce stuff that will never come into effect and accomplish this goal and be able to tick the box. Welcome to accounting.
Okay. I should have consulted with the sage accountants in this conversation before I made that prediction. So thank you for that. So my second loosely political prediction is that in North America, there's at least 5 million people that are in favor or will be in favor of tariffs without actually understanding what tariffs are.
Only 5 million? Where'd you get 5 million?
I just made it up. Like all of these predictions.
No.
Out of thin air.
I'll go higher, because I think of the people who voted for Trump, which is roughly 50% of the U.S. population, 35 to 40% of that 50% are whatever Trump says. Absolutely. It's the biggest argument against a democracy. It was like the number one Google search after Brexit. What is the European Union? I mean, people voted for it and, removed themselves from the European Union. And then the day after it happened, Googled what it meant. Yeah. So, absolutely, people are in favor of it without having any clue what it means. And it was funny that I was talking to a manufacturing operation, and they've got operations here in Canada and in the States. And he said, yeah, this is probably going to have exactly the effect he wants, because we've got a couple of contracts we were going to build here in Canada and ship to the States that we're going to have to now build south of the border in order to be safe. That's exactly the effect that Trump's looking for by talking about it. So he's already won. This rhetoric has already caused shifts in how companies are behaving. Yeah. So that's where the win is. But you're right. Nobody understands what a tariff is. And the number of TikToks and YouTubes and other videos of people trying to embarrass other people about how little they understand, and even they have it wrong. Anyway.
Yeah.
But people are in favor of it.
Yeah. Well, it's funny because sometimes I think just the way that things are branded or marketed makes a massive difference as to how they're perceived. So if all you have to do is change the word tariff to tax, and people are diametrically opposed to it. And so if we just remove the word tariff from the English language and said instead taxes on imports, are people going to lose their fucking minds? I think so, right?
Yeah. Well, no, if you think death tax, estate tax, capital gains inclusion rate. Well, those are like 3 different ways of talking about something relatively similar. And each of them would evoke a different visceral response from the electorate who don't completely understand what's being talked about. So naming things is 90% of it, like absolutely 90% of it. But what Trump is doing very effectively is picking a fight. And if you have a leader that picks a fight with somebody that's winning the fight, yeah, my team is strong. And like I said, I've spoken one-on-one with companies that have said, yeah, like we're making plans to do exactly what Trump wants to see happen, because from a business perspective, that just makes now other companies are trapped. They're one side or the other. It's going to negatively affect them and all the rest of it. But the blather that he's talking about right now is actually moving the needle, whether you want to admit it or not.
Yeah.
And just wait, that sounded way too sympathetic. I am not endorsing Donald J. Trump or any of his antics. I am just making observations. You see, Josh, this is why we don't talk about politics.
I'm sorry. I tried not to use the word Trump in any of that, but anyway, let's move on. Let's move on to some real market predictions. And this one is going to sound familiar to you because I've made the same prediction for the last 2 years, one of them being right, one of them being wrong, but I'm going to bring it back again. Bonds will outperform last year's returns.
Wow, that's a very definitive. All right, so let's be clear, short-term, long-term, corporate, government, or just the bond universe?
So the Canadian aggregate bond universe, which last year in 2024 returned 4.15% on the year, I'm going to suggest we are going to see an outperformance of that for 2025.
So is that based on a stagnant interest rate environment, or do you think the long end is coming down? I mean, I think the current yield to maturity would beat that, so a stagnant market would give you a win, right?
Yeah, so the current yield to maturity on that is
we're geeking
three
out.
and a half, about three and a half.
Okay.
Right. So we need to see a little bit of a decrease in interest rates in aggregate for that to come true, but not much. You're talking about like 0.5% or something like that will get us pretty close to that number. So yeah. So again, I made this prediction last year because 2023 was a pretty good year for bonds. I think they were up about 7%, if I remember correctly. And I thought last year we could see something better than that, predicated on interest rates coming down. Now, interest rates, interestingly, did come down for most of the year, and we were looking really good on that prediction until about September, October timeframe, where things kind of leveled out, and in the US especially came back up, in Canada a little bit less so. But yeah, so that's where we are now, and I think we could see a little bit of a decrease in interest rates continue through this year. Now today, we're recording this on Friday the 10th. Today, jobs numbers economically, things are looking a little bit rosier, so maybe I'm fighting an uphill battle with this one, but again, I think it's not an outlandish prediction at this point.
I was going to say, careful using the word "we" there, Gungadin. I mean, this is your prediction. I'll comment on it, but it's your prediction.
Oh, you're already distancing yourself from it. Okay. Okay. I see how it is.
Yeah. I'm just going to look after myself. And listen, I started it and you continue. We geeked out. So what, for our listeners, what we're talking about is, you hold a bond and it's got there's an interest rate on it. So just holding it and the bond doesn't move in valuation for the year, that is your expected return. So I was assuming it was slightly higher than what Josh's prediction was. Josh has just informed me that no, actually the yield to maturity is below that, which means there's probably more government in there than I would have given credit for. But so in order for Josh to win, the interest rates are going to have to decline a little bit. Not a lot, but a little bit, because that increases the present value of a bond. So there's two different things we talked about there that I think was a little geeky. I caught myself being geeky. I apologize. I led us into geekdom, and Josh dutifully followed me. So hopefully that clears it up a bit. Maybe put some notes on the podcast too, so people can click on and have more of an explanation on that.
So are you, when you're distancing yourself from that, are you saying that that's unlikely to come true, or you're just enough on the fence that you don't want to be there?
Recency bias, man. I saw that jobs number today. I mean, recency bias. Like I'm seeing that and I'm going, yeah, we're living through a no landing, and I'm getting more and more confident saying that. And in that environment, if it persists, and again, I'm fully giving credit to recency bias for this. That was the last thing I read before I came on the podcast. Yes. That's kind of where my head is right now. But the beautiful thing is, one of us will be right, Josh. Right? Like it's almost like an over-under. So the firm will be fine.
Yeah. If you take the opposite of every one of my predictions, we could say collectively at the end of the year that we were 100% right on everything.
That's how math works, right?
Yes. Exactly. All right. So continuing along here, my fourth prediction: the economic trend will not continue in 2025.
Okay, define trend.
So okay. Yes, this is a little bit of an abstract prediction, but what I would say characterized 2024 in terms of economic trend was slowing but still positive economic growth. And I think we can say that about just about every country on the planet. Slowing but still positive. Every developed country for that matter. So what I'm predicting here is that it's not going to be, one of two things is going to happen. Either we're going to see a reacceleration in growth, or we're going to see it be slowing and negative, not slowing and positive anymore. So it's not a really profound idea or anything like that, but I think we got comfortable last year, and markets, everything did really well last year. I think just kind of cruising along on that trend towards, I guess we would call it a soft landing. And maybe what I'm saying is there'll be a no landing or a hard landing. It won't be soft.
So what you're telling our audience is that the year that Donald J. Trump becomes president, that things are likely to be shaken up and not be the status quo. Is that a way to paraphrase what you're positing for us?
I told you I only had 2 political predictions. This is not.
I know, but you're right. I'm bringing it into this one. And I'm playing into the hysteria around various events that are anticipated to happen. And the juxtaposition of you saying, hey, it's not going to be smooth sailing next year. There's a whole bunch of our listeners are going, well, no shit, Sherlock. And they're lining up, all of what's the big events that are expected to discombobble things next year.
Well, you are very much feeding into, I think, the Canadian narrative on Donald Trump, and to sort of twist my words a little bit. But you could take any event from this year and say, this is going to be a year that shakes it up. You could Trudeau resigning. This could be a year that Trudeau resigning that shakes it up. There's political situations in every country around the world pretty much that are kind of a mess right now, quite frankly. You could look at any one of those and pick up any one of those.
South Korea, Europe, there's all kinds of stories going on. Yeah.
Yeah, exactly. So I don't think this prediction doesn't have anything to do with the political situations. It just has to do with economics don't trend exactly in the same direction for that long.
Oh yeah, no. Listen,
irrespective of what's happening.
Yeah, my tongue is firmly in my cheek. I'm not buying into it, but I'm just saying that our listeners will interpret what you're saying as like, oh my God, you've just given them credibility almost for all of the various outlandish things that are out there in expectation land. I'm not buying into it. And yes, I understand exactly what you're saying, and I probably agree. It's kind of floating in an equilibrium right now, in an odd kind of way, unexpectedly. And those tend not to persist historically. It would be interesting if it did. If we begin to persist, if this is where interest rates belong, like nobody's talking about that. This might be where they belong right now.
Sure.
Like we're always talking about the trend. Either it's got to go up or it's got to go down. It's got to do shit all. Like it could just sit there.
Yeah. I'm actually kind of glad you brought Trump into the last one, because I do have his name in this one, even though it's not exactly a political prediction. It's kind of an anti-political prediction. But my prediction here, number 5, there will be a significant market correction this year, and it won't be Trump's fault. And I'll throw in, it won't be Trudeau's fault, and it's not going to be South Korea's fault, and it's not going to be Russia and Ukraine's fault or Israel's fault. It's not going to be anybody's fault. There's just going to be a market correction this year, because really that's what markets do.
Okay, so define it. Are you talking about a 20% sell-off in the S&P? Are you talking about a 15% that persists for a period of time, or a one-day event? I mean,
that's a bonus prediction. You got to pay extra for that, Colin.
I have to pay extra.
Yeah. Good thing this podcast is free. Anyway, well, let's add some context around it. So the average over the last 100 or so years, the average drawdown in a market from peak to trough throughout a calendar year has been about 13%. That's the average. Some worse, some better. Last year, 2024, I think the peak to trough in the S&P 500 was about 8%. So it was a pretty stable, low volatility year, all things considered. And so I think it would be almost certainly more more volatile and more significant of a correction than that? Is it 15? Is it 20? Is it 25? I don't know. I think that depends a lot on the economics, but I would say regardless of the economic environment that we find ourselves in 2025, I'd expect that there's going to be a material and a correction, that an uncomfortable one, something that people feel, gets their stomach going just a little bit.
Yeah, no, that's true. I mean, it's funny because, it's interesting how often it's come up in this conversation and in previous conversations we have about how middle of the road it's been. Like it's almost like it's in an equilibrium and, less volatile than usual and not without stimulus that could have generated some volatility. Mm-hmm. But the market seems to have just kind of drifted through it, which is kind of eerie. Like you're drifting down a river and you're going, well, I thought this was whitewater rafting and where's the whitewater? And, and there's nothing here. And I think, okay. So yeah, I think the anticipation is building and there's something about a manifest destiny. If people want volatility, they're going to create volatility either intentionally or unintentionally. Because it would make us a lot more excited as money managers to have some more shit to talk about. I mean, if we see a big pullback, I don't see our group more excited than when there's a big pullback and a lot of stuff we want to buy gets cheap. Mm-hmm. So it would actually be productive if we saw one this year. Yep.
A little bit bittersweet, those things for us as well.
Mm-hmm.
Next prediction is quite closely related to that one. So I think 2025 stock returns will not be close to their long-term average. And this is another thing that was inspired from our friends at BCA Research. So the average return on the S&P 500, the US stock market over the last 100 or so years is roughly 10%, squint a little bit, it's 9%, it's 10%, whatever, but it's roughly 10%. But it's very unusual, even though that's the average, very unusual for returns to actually hit 10% in a year. They're actually more often up by quite a bit more than that, or down by some degree or measure. It's pretty rare that things end up in like the 0 to 10% range. And this is another reason why forecasts are kind of bullshit, because if you look at all the market forecasts that are out there, they're probably all going to call for, or the vast majority of them are going to call for something between like an 8 to 12% return on the market this year. And that just almost never happens. So that's just like the kind of the coward's way out. So I don't really have a specific, like, I'm not saying that the market's going to go up 30%. I'm not saying it's going to go down 30% by the end of the year. I just don't think we're going to hit that 0 to 10 or 12% mark like people would maybe anchor to, because that's the long-term average.
Well, I think it's going to be important, in anchoring to. So, I mean, we've had a bit of a good run and clients are super happy right now. So regardless of what they say or what we say to clients, they anchor on 17% is a good return. Okay, it's an amazing return, and it's not going to happen very often. So let's enjoy it and let it go, because these things don't happen regularly. So yeah, I do think it's important, and I think it's important to spend some time on this podcast trying to manage expectations. We're due for two things. We're due for a good market pullback, and we're due for a below average year. Now, having said that, neither one of us has got 100% confidence in that. So, you need to behave accordingly. There are those who would listen to this podcast and say, oh, that's it, I'm going to cash. If there's going to be a pullback and this is going to be a below average year, oh my God, the sky is falling, I have to go to cash. But, that would not be what we need. A disclaimer in the middle. Don't fucking do that. Don't use this podcast as your reason to make that kind of decision.
See, this is one thing I don't really believe in is like, we're due for this. We're due for this. We're due for that. We're due for below average. We're due for above average. We're due. That's just not the way that the market or the world works. Like, I think we've had 2 years consecutive with returns above 20% on the S&P 500. That's historically unusual. But if you look at the historical precedent for this, it doesn't mean we're due for a down year. So just because we've had good years doesn't mean we're due for a down year. Or just because we've had bad years doesn't necessarily mean we're due for an up year. Really what it means is nothing, quite frankly. Like, we can't really look at the last couple of years and say anything. So this is part of this prediction is like, if we look at the last 100 years, we're not due for an average year. We're not due for down year. We're not due for a really big up year. We're just due for something, and we just don't know exactly what that's going to be.
Oh, and that's a super fair comment, and I would agree with a lot of it. But it is human nature, and after a while, human nature does begin to affect outcomes. I mean, if people are expecting something to happen, they begin to behave as if it's going to be happening, and then it can actually lead to it happening.
Yeah.
So, but again, judging the mood of the planet is beyond my capabilities. But to simplify it for our listeners, it would be similar to flipping a coin. You flip it 10 times in a row, it comes up heads. When you flip it the 11th time, you're due for tails, but statistically, it's got exactly the same probability of coming up that time, right?
Yeah, that's a great way to put it. Like you're not due for tails. You're not actually. you're just due for normal odds, a 50-50 chance of each of those things.
Yeah, but in your head, that's the way the human mind works, right?
For sure. Yeah. So these studies, I'm sure you've read about these. These studies have been done where in a classroom of students, everyone's given a coin. Half of them are told to make up the heads, tails that you get when flipping this coin 100 times. And the other half are told actually flip the coin 100 times. And without fail, you can look at the results blindly and know which students actually flipped the coin and which ones made up the list. Because the ones that made it up think that things are a lot more random and a lot more consistent than they actually are. Like the ones that made it up, they'll go heads, tails. And all of a sudden, the ones that actually flipped it have 6 or 7 heads or 6 or 7 tails in a row. That's statistically unusual, but it happens when you flip a coin 100 times. So the world is, people don't really understand randomness and statistics the way that they should.
Or no, I don't know that they should, but they don't understand it. I can even go one deeper on this, because when they came out with the original Apple iPod and you had the shuffle function that you could just, randomly pick music off of the iPod, they were accused of being racist.
Yes.
Because every once in a while they would play 6 country and Western songs in a row.
Yeah.
And that can't happen if it's random. Well, actually, it can happen. So they actually had to program it to be unrandom in order to get people to stop accusing them of things they just weren't. So again, the human brain is not really good at math.
Yeah, that's true. It's true. That's such a great example. All right, I know the 7th prediction is going to be near and dear to your heart, Colin.
Oh, good.
I think I introduced this to you yesterday. I'm not sure, but my prediction is that at least one single stock leveraged ETF will blow up this year. Blow up, like totally blow up.
Like be taken off the market, blow up?
Yeah, that's my thinking. Yeah, go to zero, to be taken off the market, blown up. So just to explain,
which one?
I did, again, bonus predictions. Give me some more money, I'll give you more predictions. But no,
we need to introduce a subscriber service that if you subscribe to us and pay us money, Josh will actually give you all the bonus predictions.
Yeah, look us up on Patreon. There's a Patreon there for us. But no, so just to explain what this is for our audience, for our listeners. So these new ETFs, exchange traded funds, these new investment products have come out where they take a single stock and they lever it. So they give you twice the returns to the upside and twice the returns to the downside, or something along those lines, on a single stock. So the first thing is, this is total horseshit, because this is the simplest investment to implement, maybe slightly less simple than a single stock covered call ETF, but pretty damn simple. So simple to implement from an investment perspective. And these, I just looked up one company that's charging 1.15% on an annual basis to do this. And as I said yesterday, I could literally run all these ETFs from my basement in my underwear on my own, without a single employee at my entire organization. That's how simple this stuff is to implement. And they're charging 1.15% on this stuff. So leverage has good attributes when the stock or whatever it is that's levered does well. And it has some potentially very damaging or detrimental attributes when that investment does not do so well. So it magnifies both gains and losses. And I think at some point this year, one of these companies is going to have a pretty substantial loss or pretty substantial decline on their share price. And as soon as you lever that, you get double that loss. And that can be as I've said, I think something's going to blow up this year, because this is just the most idiotic product that's been launched in a while, in my opinion.
Okay, in a while. Okay, so you qualified it. I thought
Not,
you were
not
going to call it the most
ever.
idiotic.
No,
Because that's a
no,
high
not
bar.
ever. It is a high bar, and I'm sure I'm forgetting something, but I thought the single stock covered call products were stupid, because again, it's something that's very easily implementable by an individual for probably a thousandth of the cost. And I think this is more risky, just as simple to implement, but riskier for the investor. And people are going to get caught up in these things and the potential returns that they offer.
Yeah, no, I can't disagree with you. The one way to explain the levered thing is if you're 50% levered, like you put up $100,000 and you borrow $100,000, if you suffer a 50% loss in the investment, you lose 100% of your money.
Yeah.
So that's how that math works. And I've lived through the presentations that were given back in the day where they put an application for a mortgage on your house on every chair. And, somebody stood at the front of the room and talked about all the beautiful things about leverage, how everybody needed to lever up their house to go buy investments. And that doesn't happen anymore because it blows up and it's not a sure thing. And it's beyond the risk profile of most retail investors, to be honest. And if you think about it, many retail investors have leverage in their life because they borrowed to buy a house. And, that's very significant leverage. And there are people, we've got clients, and especially in the environment right now where you've got a mortgage that's worth more than your house is worth. So that's how leverage feels. Like you can dig yourself a hole that can take you a while to dig out of. So something to be very, very careful with.
And I'll be looking forward to see which one blows up. Or two, or whatever.
You need to share with me the list you're watching. I have my list I watch. I'd like to see your list. And with Josh, let's just call it out here. I'm calling you out. It would be easy to implement for Josh Sheluk, a seasoned investment professional with a CFA. The average person may struggle to execute on some of these strategies.
I did not say that the average person could sit in
Just
the
wanted to be
basement
clear.
and execute all of them.
Yeah.
I think to add 100% leverage to something, I think most people can do that with maybe a little bit of coaching. But the thing that I'm criticizing here is not the people that go buy these products. It's the company that decides to launch them and charge 1.15% for doing this, because their cost structure on doing something like this is basically zero. So, and this is why, one capable person could run this entire organization of leveraged single stock ETFs with very little difficulty. Like they could be on a beach for 7 hours a day and run these portfolios for the extra hour per day. And that should not be something that you can charge 1% for, is the point.
And have the product actually be a small part of your income, because the rest of your money is going to come from the YouTube channel about you only working an hour a day while you're sitting on the beach. That's where the real money is.
Yeah.
And then the merch on top of that, it's a whole business model, Josh.
Yeah. So last year it was the single stock covered call ETFs. And I think those things probably did pretty poorly relative to just buying the stock last year, because the stocks were up pretty significantly on most of that high flying tech stuff. So it costs investors a whole bunch of money implicitly, opportunity costs mostly on that stuff. And now this is going to actually literally lose clients money at some point. So it's
all right. So
sad.
you didn't hit one of my predictions. Are you finished with your predictions?
I'm done. Take it away.
So as you have pointed out, Josh, we've seen a couple of good years back to back. The markets have done well. Confidence is high. I repeat, confidence is high. I'm beginning to see the early days of the return of the day trader.
Ooh.
Because it is so easy to sit at home in your muscle shirt and short shorts after your workout and talk to the world about how much money you made today. I am beginning to see that reproliferate. So we are entering the overconfident phase. And there are enough people out there who have had a little bit of a run of luck. They've been in the markets in a good time and they've made some money. And they're now saying it's easy. Here's my strategy. I only trade for an hour a day. Here's exactly what I do. You can do this too. And they're selling the lifestyle and they're making money off their YouTube channel. And it's getting traction because we've had a period recency bias, that has been relatively easy to make money because the rising tide is raising all boats. So I am predicting this year confidence will grow to a level that we will see a return of the common day trader kind of mentality, and that little cottage industry will see an explosion of influencers talking about their various strategies. And it will anger me to no end and cause me to slap my forehead a lot, because I have already had to slap my forehead. There was one guy on there talking about how his method of back testing guaranteed future success, because if you could come up with your trading strategy and back test it over a period of time, that's the smart way to do things. And it's like, oh no.
Because no one's ever thought of that before.
It's like looking in the sky and picking out a pattern. Of course there's a pattern. There's a few billion stars up there. Yes, you can make whatever the fuck you want out of it. So I'm predicting that's going to become a bigger thing this year. I think it's going to enter the zeitgeist a little bit more, because we're entering a period now where confidence is exceedingly high for all the wrong reasons, and it's been very difficult to fuck things up. There are people who have managed to do it, but it's been more difficult to fuck things up.
Yeah. Don't you think it was 2020 though that this actually reemerged as a big thing during COVID?
Yeah. It certainly got some traction, but the volatility there was a little bit harder to spin a really good positive news story, because there was a sell-off before there was a takeoff and all that kind of stuff. But I'm just judging by my feeds and what I'm seeing, right? So you're right. I could have built a case that in 2020, when everybody's forced home and got nothing else to do but sit in front of their computer, that maybe you would have seen more of a proliferation. But I try to maintain a really wide view on what's being talked about. Like, I click on odd things, I follow odd things, I look at Fox News, just to kind of try to maintain some kind of perspective on what's going on. And recently I've bumped into a whole shit ton of it. And I'm not sure where. I think it's one of those ones where maybe one of them had success, and then as soon as somebody goes, all right, that's working, and there's a bunch of hangers on. But I can see it being born out of a couple of pretty steady years of confident growth in the high-tech sector doing well, which appeals to the nerd and the young people. There's one guy in particular who goes, I'm a 20-year-old day trader. I've been doing this for 5 years. It's like, you've been day trading since you were 15?
Yeah.
Okay, good for you.
Yeah. Yeah. I know. I think what you're saying there is definitely true. Is there's a high correlation between market success, market returns, and the proliferation of do-it-yourselfers, or people that are confident in their ability, and apparently influencers that are do-it-yourselfers as well.
And that's where the business model gets a bit funky, because you can be confident in what you're doing and make money at it, but if you really make more money talking about making money, that's a little fucked up. But that is kind of the world that I think that we're existing in right now. So maybe it'll persist a little bit longer. But overconfidence is a thing. It's funny. The old expression is not what you don't know is going to hurt you. It's what you think you know for sure that just ain't so. And again, I've said it before. If you think you could sit at home and computer in your pajamas, and you've picked out a pattern that the trillions of dollars and millions of people that troll the internet with high-speed computers that compete on picoseconds, you think you found something that they haven't found and you can exploit it, I'm going to call you optimistic, for sure. And maybe you'll get lucky for a while, but to think you've got some kind of sustainable advantage or moat that the trillions of bots that are trolling the internet haven't figured out, I think you're going to get crushed at some moment.
Yeah. And speaking of which, I was just talking to somebody yesterday about implementation of AI into quantitative strategies that are looking for these types of patterns. So again, if you think that you in your pajamas at home in your basement can do a better job at identifying these patterns than some of the complex, sophisticated, intelligent AI systems that are out there, plus the millions of other nerds that are out there that have PhDs and things like that, scouring the internet for this type of things, that's overconfidence to the max.
Well, it was a book I read a long time ago, Long-Term Capital Management When Genius Failed. So it was basically they were one of the first groups to really get into global arbitrage, which means they would find a mispricing between the Australian bonds and the Canadian mineral sector or something, and they would find these arbitrage opportunities and place bets. But the problem was, as the world got more efficient, those arbitrage opportunities kept getting smaller and smaller and smaller, and they kept having to borrow more and more money, and it became less reliable to find them, because that's how the market works. If there's a reliable pattern that people can profit on, there's going to be a lot of competition for it, and it's going to get competed away at some point. And again, sitting at home in your pajamas trading, you can be lucky for a while, but to think you got some kind of sustainable advantage that's not going to get competed away is, maybe misplaced.
You got anything else for us?
No, that was my big finish. I think 8 is a good number. And I would like to applaud both of us for not coming up with a round number saying we need to come up with 10 predictions and then having 2 bullshit things we say at the end just to call it a 10. I think that's a bullshit game and that other people play. If it's 8, let's call it 8. Let's just leave it at 8 and be held accountable thusly.
Thanks, Colin.
Thanks, Josh. If you're breaking a sweat trying to figure out what your financial advisor is talking about, you're not getting the service you need. You probably hate trying to get an answer from them, but you also think moving your accounts will be a headache, and it might be. But working with don'trocktheboatwealthplanning.com or .ru isn't exactly stress-free, is it? Call us. We will demystify the world for you.
For more information on the subject of today's podcast or any other financial topic, please visit us online at verecan.com. That's verecan.com. There's plenty of information there, or you can reach out to someone on the team. Thanks for listening. Please note, the information provided in this podcast is for general information purposes only. It is not intended as financial, investment, legal, tax, accounting, or other professional advice. Our discussions are not a solicitation to buy or sell any securities or to make any specific investments. Any decisions, based on information contained in this podcast, are the sole responsibility of the listener. We strongly advise consulting with a professional financial advisor before making any financial decisions. Listeners should be aware that investing involves risks and that past performance is not indicative of future results. Barenaked Money is produced by Verecan Capital Management, Inc., a licensed portfolio management company in Canada. We operate under the regulatory framework established by the provincial securities commissions in the provinces within which we operate. The views expressed in the podcast are our own and do not necessarily reflect the official policy or position of any regulatory authority. Remember, at Verecan Capital Management, Inc., we focus on aligning our goals with yours, prioritizing integrity and transparency. For more information about us and our services, please visit our website. Thank you for listening, and let's continue to challenge the norms of the financial services industry together.